This is Blue Nile. Let's dive into the basics with an introduction to current assets. Current assets are short-term resources owned by a company that are expected to be converted into cash, sold, or used up within a year. These assets play a vital role in a company's day-to-day operations and liquidity management. Key types of current assets include cash and cash equivalents, readily available funds like cash in hand or in bank accounts, accounts receivable, money owed by customers for goods or services sold on credit, inventory, raw materials, work in progress, and finished goods available for sale. Prepaid expenses, payments made in advance for goods or services yet to be received. Short-term investments, investments intended to be liquidated within a year. Auditors focus on verifying assertions like existence, valuation, and completeness to ensure current assets are properly accounted for. Let's get started with our tutorials. This video will cover some practical ideas and examples of how an auditor will audit current assets. We are going to cover the audit of bank, receivables, estimates, and inventory. Bank is an asset presented in the financial statements. It is shown under the heading Current Assets in the Statement of Financial Position. The key assertions that should be verified are existence and valuation. The evidence that the auditor would obtain to audit the bank balance can be referred to as the 3 Bs. These are the bank statement, the bank report, and the bank reconciliation. The bank statement is a piece of independent evidence. It will show all movements in the bank balance during the period that can be agreed with the movements in the cash book. It can also be used to agree the balance used in the bank reconciliation and make sure it agrees with the bank records. This evidence verifies existence and valuation. The bank report is written confirmation from the bank. It is sent directly to the auditor from the bank, and so is a brilliant piece of evidence, as it is independent, direct, written, and in its original form. The bank report confirms all of the bank balances held by the client for the year. It will also confirm any balances of liabilities held by them, so it will assist the audit of that area of the financial statements also. The auditor should ensure the bank accounts have been included in the financial statements by agreeing the bank accounts of the trial balance. The balance itself may not agree due to timing differences, and so they should also agree the balances to any bank reconciliations prepared. This verifies existence, valuation, and also completeness. The bank reconciliations will show the differences between what the cash book states as the bank balance and what the bank states as the balance for each bank account. If the client prepares these, the auditor must inspect them and ensure the movement between the balances is not due to a material misstatement. One of the first procedures is to cast or add up the bank reconciliation to ensure there are not arithmetic mistakes. They should also ensure the balances agree to the bank statement, bank report, and cash book. They would then audit the timing differences. Any payments that have not yet cleared the bank are unpresented checks. The auditor would need to verify that all of these payments have been included correctly, and so would usually agree the amounts on the bank reconciliation to the check stubs and cash book. Ensure none of the payments are missing or belong in the following period. And inspect the bank statements after the year end to ensure the payments have now cleared, investigating any that have not. Then any uncleared receipts would be audited. They would need to agree that all uncleared receipts on the bank reconciliation are in the cash book. Ensure that there are no missing receipts from the cash book. And inspect the bank statements after the year end to ensure the receipts have now cleared. The next balance to review is the receivables balance. This balance is actually made up of 2 in the ledger, the trade receivables and any provision for bad debts. We therefore need to look at some practical ideas how to audit not just receivables, but the estimate that is the provision included. Firstly, let's look at trade receivables. There are three important tests that should carry out on this balance: circularization, cash received after the year-end, and cutoff. Circularization is writing to a sample of trade receivable customers, requesting that they confirm the balance they owe from the records. This is a great independent piece of evidence, as the letter is sent from the client, requesting that the information is sent directly to the auditor. Not all responses will be received, as it is not a legal requirement, and so customers do not have to respond. The auditor can send follow-up letters or a call to the customer to request the information, but should not harass them. If the response is sent and it agrees with the client ledger, then there is no further work needed, and it can be filed as evidence in the audit file. If the response does not agree with the ledger, the auditor will then need to complete a reconciliation between the client and customer balance to identify if the difference is due to timing issues or due to a misstatement. If there is no response, then the auditor may wish to investigate that the customer does in fact exist. An example would be to inspect post-year-end bank statements for evidence of customer payments. The auditor will also select a sample of receivable customer balances and then agree these balances to receipts in the post-year-end bank statements. This will again verify existence of these customers, and any where there have been no payments should be investigated further. Cutoff testing should be performed to ensure the sales invoices recorded on the ledger are in the correct financial period. As receivables is an asset, they will be concerned that this balance may be overstated. The client may push invoices into the current year to make this balance and the revenue balance look healthier. The auditor should review invoices just before and after the year end, and inspect their goods dispatch notes, reviewing the delivery date to ensure they are in the correct period. The next step is then to audit the provision for bad debts. Like any estimate in the accounts, this is difficult to audit, as there will be little in the way of external evidence. The key assertion to verify is valuation. This provision has been created by the client using their own judgment, and so the auditor must obtain evidence to ensure they agree with it. Examples of procedures include comparing the provision to the previous year and investigating any differences. Other analytical procedures, such as calculating the receivable days ratio and comparing to the previous year. Reviewing the aged receivables list and investigating old balances to see if they should be included in the provision or written off. Inquiry with management about any specific provisions. And post-year-end event review to see if the customer has paid or is maybe now unable to repay the debt. The final balance to review from current assets is inventory. The key assertions are valuation, existence, completeness, and rights and obligations. This balance has a very specific accounting standard which shows us how the balance should be included. The most important and remembered element from IAS 2 is that inventory should be valued at the lower of cost and net realizable value. The auditor must prove that the balance has been correctly accounted for to verify valuation. They should ensure they review sales around the year end. Sales prices of items should be compared to the calculations for net realizable value to ensure the selling price looks reasonable. They should also trace the cost used in valuation to the source documents such as the purchase invoice. Existence can be verified by attending the inventory count. If the auditor attends, they can observe the count and the actual inventory. This not only verifies this assertion, but it also enables the auditor to review the control procedures carried out by the client. The audit team would need to be organized and ensure there are staff available to attend the count. Whilst at the count, they also reperform samples of the count to verify existence and completeness of the counting records. Inspection of ownership documentation should also be carried out. Review of the purchase invoices, for them to be addressed to the client, verifies rights and obligations. Also, inspection of any inventory stored at third-party warehouses needs to be carried out. The auditor should inspect agreements with the client and ensure inventory belongs to them. We have now covered some specific ideas in auditing the current asset balances. The next video will cover the audit of liability balances. Thank you for watching.